Welcome to the next stop on your journey from paycheck to pension. If you're ready to take your finances to the next level, you're in the right place. It's time to take control of your future, starting now, and we're doing it live. Hi, we're the Stidhams, and our goal is to help you get self-directed. It's the tax-free income that will shape your legacy. It's wealth, time, and the freedom you deserve. What you're about to learn will enable you to make confident and strategic moves. It means gaining complete control to invest in what you want when you want. We've helped thousands of people just like you. And if they can do it, you can too. So we hope you're ready, because it's about time that your money started working for you. And we're so excited that you chose us to show you how.
Starting right now.
Good evening. Tonight we're going to be talking about the new executive order Trump signed in, the 14330.
14330, yeah, I think that's what we labeled it, right? 14330.
14330. And why wasn't this a bill? Why was this kind of rushed through? What does it mean for your 401k? And what are they not saying about traditional retirement plans? More importantly, how can you leverage this? Or do you need to pay attention to it at all? That's what we're going to talk about tonight. And I think that if you have a 401k, if you know people with a 401k and they are not paying attention to this, they need to. So please share this out with someone you respect.
Yeah,
How about that?
I think the biggest question to answer tonight is who benefits? Like, on the surface, this is a pretty awesome opportunity as it relates to traditional retirement accounts. Like,
Right.
Amazing opportunity. But the question you want to answer is who truly benefits? And we tend to pull back curtains and look under stones and try to figure out why people are saying what they're saying, not just take things at face value. So we're going to dig into a lot of that. And I would consider this a pretty important stream tonight, because we're going to hit on some topics that, if you're not paying attention, it will fly right by you. I think we can all agree we're living in an age of distraction. And so you kind of have to question, what are you being distracted from? What is it? What is the real meaning behind it? So if nothing else, continue to ask the question, who benefits?
Well, and we're going to tell you who benefits tonight. We're going to break this down from all sides, actually, from the side of the worker, from the saver, the average American who has been relying on 401k as a tool. And we're also going to talk about who is managing these funds and what benefit it has been to them for decades now. And specifically, what's in it for them with this executive order? That's probably the most important part that you need to pay attention to, not just because maybe it's more options. It's what are the options and why were they presented? More of this coming up. Okay. All right. So you ready to get started?
Of course.
Okay. So again, get in here. If you have somebody who also that also has a 401k, who doesn't? Well, actually, we're going to peel that back. There's a lot of people who don't. But share this out with someone so that they can get educated too. All right. Ready to jump in?
Let's do it.
All right. Here we go.
1, 2, 3.
The goal should be, where can I achieve exponential growth? Exponential growth.
Let's just get into it. Let's just get into it. Yep. Sorry. Here you go.
So again, what we're talking about today is this executive order.
Hold on. Start over, because I'm sorry. You were muted.
No problem. And I'm no longer muted?
Nope. You're good now.
Okay, good. So what we wanted to do was kind of highlight this executive order that came out maybe somewhere around 90 days ago. And it has the potential of having some significant impact on your retirement account. And we are kind of highlighting mainly 401ks, but this doesn't only impact 401ks. This impacts those defined contribution plans, and I'll get into what those are. But I think the one that people it's easy to resonate with is this is going to have a heavy impact on 401ks and plans like it. And we will dig into not just what's being covered in the order, not just what's being covered in the executive order, but also what is the impact to you and what are they not telling you? Again, a question that I want to answer tonight is who benefits? Who benefits from this executive order? And who benefits on the surface, but also who truly is going to reap what is going to be potentially identified as this order kind of falls through. And you kind of mentioned this earlier as you were going through the introduction. This is not a bill. Why? It's an executive order. What does that mean? Well, the reason this is not a bill is because there's a process in order for this to become a bill. So main point is, hey, obviously someone wanted to get this through quickly and wanted to avoid any, I'll call it red tape that being tied up with Congress. So no political impact. And we're not going to dig into the different levels of branches and how and why, how a bill becomes a bill. But the moral of the story is it's not, because the objective was to push this through. And there may be a little bit of controversy here, but I don't really think so. There is a possible conflict. This bill has a potential benefit to the office of the president. So is it possible that this executive order is being forced through because there's a potential benefit to the office of the president if this is done? And then ultimately, who is actually asking for this? I would love to see in the chat, if this was a part of what you wanted the government to provide to you, you wanted the ability to access more alternative investments inside of your 401k or inside of your company's retirement account. Is this something that you asked for? Who actually is lobbying for this change? And again, I go back to the question you want to answer is, who benefits? But let's be clear as to how it's being framed. It's being framed as this is an executive order meant to help the average saver. Who's the average saver? Well, we've got some data around who the actual average saver is, and I'll zoom in on these areas as well. As of right now, there's about half of us who are not even saving for retirement at this point in time. So if we're talking about this is meant to this order is meant to assist the average saver. There's about 50% of us who aren't even saving for retirement, and 31% of those have no retirement savings at all. 6 in 10 Americans have a retirement account, something like an IRA, 401k, 403b, TSP, 6 out of 10. And then the average 401k contribution itself for 2024 is about 7.7%. But if your goal is to stop working, if your goal is to make sure you don't have to work for the rest of your life, there's a little data around contributions that say about 15% of your income should be going towards your retirement vehicle, so that it can be able to replace your income once you do finally retire. So the moral of the story is you need 15% to maintain your lifestyle. And right now we're sitting around 14.3, which is actually pretty good. But the bottom line is this is the average. These are the people that this executive order is meant to assist. And again, as you're going through this, ask the question, is this assisting these people? Because these are the ones who need it. And to kind of further go into that a little bit, if you're between the ages of, let's say, 50 to 70, on average, your retirement account balance is somewhere between $200,000 and $400,000. Is that a lot? And again, this executive order is meant to hopefully improve this, right? But again, as of right now, somewhere between the ages of 50 and 70, your retirement balance is somewhere between $250,000 to $400,000. No one ever talks about what does that mean in income. If you're 70 years old and you're looking at your retirement balance and it's on average somewhere around 400,000, what does that mean for you as it relates to income? Well, if you were to Google the Trinity study, which will highlight the 4% rule, you would learn that on average, a $400,000 nest egg would produce somewhere around $16,000 a year in income. Is that enough? Is that enough for you to live off? And again, these numbers are average, which means some are higher and some are lower. But right there in the middle, right there on average, this is what we're looking at. And this executive order is hopefully designed to improve this. Because again, these are the average savers. Go ahead, sweetheart.
Well, I just want to pipe in here for just a second, because there's two things that we already know. We know that there's a deficit in retirement funds,
Right,
to be able to receive retirement income from them, right? So we already know that. But here's the other part. This is a lot A lot of people are referring to it as the silver tsunami, right? Okay. And that's this group, right? In the 70s. This order, this is where the bulk of these funds are.
Right.
This is who this would mainly apply to, because this is where the funds, the capital would be for them to expand their opportunities, right?
Right.
Is this the time to expand your opportunities?
And again,
And who in this 50 group is waiting for whatever would be left over from this 70 group, right? This windfall, they're looking for the silver tsunami to be inherited. I just want to put that note out there so that you can keep this in mind when we are peeling back the layers. We're going to go through what this order says, what it means, what it's not saying.
Yep. And one other piece to note is this average saver that we're referencing. This is a breakdown of the total amount of retirement dollars in our country. So there's a total of about $46 trillion in retirement dollars as of somewhere around quarter Q1. Well, of the dollars that impact or affect this executive order, about 12.2 trillion of that is impacted. And now, again, I know I'm talking heavy about 401ks, but this includes several other accounts. But I just want to, again, for memory's sake, I just want to make sure you associate this 12.2 trillion dollars with plans like employer plans like 401ks, and that's about 26.6% of that total $46 trillion that's available. So currently, this 12.2 trillion is where? Where is this 12.2 trillion today? Today it's in mutual funds, stocks, and bonds. This is what you have with Fidelity, Vanguard, Edward Jones. These are the elections that you made in that target date fund. So as of right now, this is the dollar amount that this executive order is targeting, just to be clear. And this is the order. And we printed out the full order. I can read the full order if you would want to. But I want to just highlight what this is. It's called Democratizing Access to Alternative Assets for Your 401k. And I think this is the term of the quarter that you're going to be hearing, democratizing. What does that even mean? Ultimately, it's just saying as of today, your 401k cannot access alternative assets. So the goal of this order is to allow your current 401k to be able to access asset classes that it can't currently. So again, what is your 401k? What is your company's retirement account currently invested in today? Mutual funds, stocks, bonds, target date funds. The objective of this executive order is to put your retirement dollars in a position so that it can access other things. And so what we're going to do is, again, we're going to break down how this order impacts your current retirement account. And I'm talking about the retirement account with your employer. So we're going to talk through how this order impacts that. And in addition, we're going to highlight what the order is actually saying. So the Secretary of Labor, this order directs the Secretary of Labor to examine the guidance currently identified under ERISA, which is basically the governing body since 1974 of how retirement accounts are accounted for. So it's just the Secretary of Labor is going to re-examine the guidance and the duties associated with retirement accounts today, and to understand how we can add alternative assets to it. What are those alternative assets? You've heard it many times on this channel. We're talking about land REITs subject to self-storage facilities, private equity, cryptocurrency, real estate. The list is really quite lengthy. But the bottom line is, the goal is to assess over these next 180 days, which in truth, there's about 90 days left. Over the next 90 days, assess what it's going to take to be able to add these alternative assets to your retirement account. And the objective is to consider what those ways are so that you, as the average saver, can have access to these opportunities inside of your current retirement plan. And let's be clear, on the surface, this sounds like a beautiful thing. Because again, we talk about often, right now your company's retirement account only allows you to buy mutual funds, stocks, and bonds. Like, woohoo. Everything is tied to the market. What if you could remove those funds from the market and be able to invest in other things? Like, this is a positive. But let's make sure we continue to peel the layers back. What does this ultimately mean for you? It means that, yes, there's a clear path for the 401k managers. Who are the 401k managers? Who are the retirement account managers? Who are the fiduciaries associated with employer retirement accounts? We're talking about the Morgan Stanleys, the Edward Jones, the custodians, the banks, the financial advisors who identify where the opportunities are. So this will clearly create a path for these institutions to now offer things other than mutual funds, stocks, and bonds. So that's a plus there. But in addition, remember that 12.2 trillion we talked about? This potentially opens up the alternative asset class to about $12.2 trillion. If I could show you how to access $12.2 trillion, would you want to? So and that 12.2 trillion is about 20% of the overall market.
Where is it sitting? This is why I was bringing this up. I was planting the seed. Are you guys picking up what we're putting down? Who has all this money? Where's the money coming from? 70 and up. That's who has all this, who has the majority of these funds, right? It is so important to pay attention to that part. Who is over 70 and they are not planning on, it's the run, walk, crawl.
Right.
They're not slowing down to protect, right?
Yeah, and just to kind of highlight what it is you're saying there, in most cases, when you're dealing with target date funds, the objective is when you're younger, you're going to be as aggressive as possible to invest in those, I'll call it more risk, high risk areas. But as you approach age 50, 60, 70, as you're approaching retirement, you want to reduce that volatility inside of your asset class and move to more bond related actions so that you have the money available to you when it's time to retire. You need your money most, which is a backwards way of thinking about things, but that is how our traditional retirement account is set up. So you're right. The majority of the people who have this $12 trillion assets that would be available, accessible to be able to invest in these non-traditional investments, majority of them are in that time of or period of life where they should be focused on less risky items.
Yeah, so I get that fiduciaries are managing these funds. However, do you want your fiduciary who's been dealing in mutual funds for the last 20 or 30 years to now all of a sudden be doing real estate deals just because they can, just because they're allowed to add it on and because they're encouraged to do so? We're going to talk about that and we're going to peel some layers back on how fiduciaries are kind of looking at this right now. But just from where you're sitting and how you're receiving this information, where are you sitting with this? Like, do you trust this, that your job has entrusted someone else to make decisions about your funds? And would you be okay if all of a sudden they just decided for you that this is what was going to happen, or they decided for your parents, right? Because maybe they've retired, but their funds are still with the same custodian, right? Their funds are still managed by the same company. Would you be okay with your parents' funds now being allocated into these alternative assets by somebody who has not been in these asset classes? This is not what they were doing before, but now they have permission to do so.
And I think permission is the key. Permission is the right word. It's not a requirement though, right? You still have the option to say yes or no, but it's the fact that we are now opening up this asset class, this what was considered a protected asset class, to those non-traditional investments.
Yeah, okay, well, let's keep going here.
And so, again, democratizing access to alternative investments. Again, what is the meaning behind this order? What is the goal? Well, the goal or the objective is for everyday savers to finally gain access to alternative investments. And again, on the surface, this makes 100% sense. Why? How do most people become millionaires? Most people become millionaires from investing in real estate. What if my tax advantage retirement account that I have with this employer that I spent the last 25, 30 years with, what if I could take that $500,700,000 and invest in asset classes outside of the market that has the potential to do what the 1% have been doing for a long time, and that is investing in real estate. Like, how awesome could that be? So on the surface, yes, I am with it. But from a fund manager's perspective, from a fiduciary's perspective, let's take Fidelity specifically. What's in it for Fidelity? Well, before I had access to this $12 trillion, because the $12 trillion is sitting with a fiduciary, a fund manager anyway. It's in mutual funds, stocks, and bonds. So now this 12 trillion has now been opened up for me to be able to invest in other things, or for me to be able to invest for my clients in other things. So there's a potential there for a higher return. There is. And as it relates to who is actually going to be doing this? Well, we're talking about the private equity firms, the hedge funds, the crypto firms. These are now opening up opportunities where they didn't exist before. And let's step back for a minute. I would love to hear about it in the chat specifically. Any of you have a financial advisor, a fiduciary, a financial institution that holds your retirement dollars and charges zero fees? Does it exist? Meaning, in your current company's retirement account, does that retirement account have a zero fee structure? Short answer to that question is no. So if we're going to add additional asset classes to the Fidelities, to the Morgan Stanleys, are these additional asset classes that we're adding to these fiduciaries coming at a zero cost? We know it's not. So this $12 trillion not only have been unlocked to be able to be invested in non-traditional investments, but we're also opening up a new fee structure. And you better believe that new fee structure is going to be open. But let's peel this back a little bit further. Would you pay an additional 4% in fees if you could have access to? I was just on a webinar with Chris Crone, and he was talking about his portfolio is making somewhere between 30 and 60%. Chris Crone being a real estate entrepreneur. So if you had the opportunity to make an additional 30 to 60% inside your portfolio with your current company's retirement account, but it cost you an additional 2 to 4%, would you do it? I think the short answer to that question is yes, because again, on the surface, this math is mathing. But what's actually happening with investors? Yes, more choices are being opened up, but we have to understand the responsibility of these choices. As of today, in your current retirement account that holds mutual funds, stocks, and bonds, how much can you hold Fidelity, Morgan Stanley, Edward Jones accountable if the market crashes? You can't. You cannot hold them accountable if something happens to your retirement account, even though they're following a fiduciary standard, meaning even though they have your back. So as this evolves and as we add more assets into this class, the objective of the fund manager is they have that same protection, which means you're adding more risk, you're creating more complexity, but there's less transparency and there's the opportunity of more fees and higher risk. Does that make sense?
Man, where are these, like, let's take real estate for example. Where are these opportunities going to come from? Because they're not coming from people who are doing fix and flips, right?
Right.
They're not coming from there.
These
So
would be hedge funds.
who's doing enough real estate deals,
Yeah.
right? Who's investing in real estate at such a rate?
BlackRock.
It's BlackRock. So how many pockets, how many hands would be in your pockets then? And again, they are not liable if the deal goes bad.
And this is not happening for free.
Right. On top of that.
So speaking of fiduciaries and their protection under safe harbor plans, again, what you see this is just me reading the bill, just so the executive order, just so we're clear. This is just reading the executive order. So these are not my words. What they want you to see is your plan is now being responsibly managed by a Fidelity, a Morgan Stanley, and it's allowed, so which means you have new protections. Remember how you are protected with the mutual fund stocks and bonds that you have. You're just not protected against market crashes, but you have someone who has your back investing on your behalf. Awesome. Well, what if we could do that with more assets? Sounds like that would be awesome. But let's be clear, from a Fidelity perspective, in order for Fidelity to be okay with you buying a REIT or a rental property, in order for Fidelity to be okay with that, they need to have some type of protection against lawsuits. Because you don't know, you as in the person contributing to the retirement account, you don't know what the right thing to do is. So there's going to be some advisor that's saying, here's where you should put your money to go get that 15, 17, 22, 35% return on your investment. So there has to be some protection put in place so that they aren't held accountable if things go bad. And so what that actually means for you is, yes, you are now buying these new assets under the guise of a fiduciary, but you still carry all, not some, you still carry all of the risk. You okay with that? And again, I'm saying it slowly because this executive order has a lot of pop-in stance. There's a lot of excitement around this order, but no one is looking at the detail and no one is actually highlighting what this means to you. And I get it. This executive order encourages long-term growth. Again, most millionaires become millionaires via real estate, via investing in alternative investments. So isn't this an opportunity for you, the common average saver, to be placed in a position to where you can build and generate more income, more wealth over time to be able to put yourself in a position to be in that millionaire class? Like, again, I'm on board 100%. But we have to peel that back a little bit further. What does that mean? It means that this isn't happening for free. This means that the company you are working with to be able to invest in these alternative investments are taking a piece. And that piece is not small. We will break down what it means, what the fee structure looks like inside of these accounts currently. But just remember, that fee structure is not a small piece of your retirement. And then ultimately, what this actually means for you, it means higher costs eating away at your compounding returns. So I go back to that original question. To receive 30 to 60% returns, and again, I'm being quite ridiculous with these return on investments, but to achieve a 30 to 60% return, would you openly, lovingly accept an additional 2 to 4% on top of the fees that you're already paying? I think I would. Like, if you're going to give me a 30% return off this investment, would I pay an additional 2 to 4%? Yeah, I think I would. But you have to understand what that honestly means. And ultimately, freedom. We talk a lot on this channel about your WTF moment. Putting yourself in a position to be able to generate wealth, have more control over your time so that you can produce true freedom. What does freedom mean? Freedom means the ability to do what I want, when I want, with who I want. So on the surface, what does this look like? Well, if I am now no longer just limited to mutual funds, stocks, and bonds, I now have more freedom to put my hard-earned retirement dollars into more vehicles. I'm empowered. I actually am in a position to now make more money. Again, if this is all we're talking about, I'm on board. But let's go a little bit deeper. What does that mean for your fund managers? Well, right now, your mutual fund stocks and bonds have to follow a certain set of guardrails that says you can't move outside of this. In order for your 12 trillion in retirement dollars to be available to be invested in non-traditional investments, those guardrails have to be pushed back, lowered. There has to be more space created so this 12 trillion can be invested. And so, and what that means is we have to involve some people. There are some hedge fund managers and there are some private equity firms that need to be partnered with the Edward Jones and the Fidelities. So there's more hands in the pot as it relates to your retirement dollars. And again, you did say you would give up, I did say, I would give up an additional 2 to 4% return to achieve 30%. I did say that. Go ahead.
Well, this was the order that Biden had put in place to protect, and it was a red flag that said, do not even talk about crypto or any of these alternative investments when it comes to qualified retirement dollars. We're not even going to talk about it. It's not safe. We haven't figured it out, and we haven't figured a way to protect Americans already with the funds that they're already investing in. And so we're not going to do it. And now Section 3B, I don't know, I think you had cut out Section C, but Section 3B says you have to reverse that order, which means any protections, any additional protections for the people. Now we're going to put those in, we're going to replace them essentially with more protections for the fiduciaries. And there's a reason why they need protection. And I could understand if this was me, this is what I did for a living, and I really did care. I'm not saying that everybody's horrible out there. I mean, you're a fiduciary, right?
Absolutely.
It's an oath that you take to have people's best interest at heart. But when you are in the position of advising and making decisions on, and you have a direct reward, right, or incentive for those decisions, and you're not tied to the outcome, that's different to me. And there does need to be protections in place for the people. It's their money, literally all of it. If we have something like this in the last phrase that you had just went over, it's the layered fees, right?
Mm-hmm.
It's all of the people that are involved. There's already far too many people involved, which is where the deals are going down that says, I will only work with you. And you have no idea what's going on. You're just logging in and looking at your account, and you're hoping that you're seeing an upward trend. But you have no idea why this particular fund was chosen, what's going on behind the scenes. And there are a few documentaries out there that do uncover a lot of this. And I hope that you guys will take a moment, an hour or two, to go and watch those, because they are very, very eye-opening. The most important part, though, is the making things looser for fiduciaries. Now, this has really excited some people. This has scared the mess out of others. And I think I'm paying more attention to those who are a little terrified of what this is from a fiduciary standpoint. They are steering away from it. This is a huge red flag for them. They are, don't touch it with a 10-foot pole. They are, don't drink the Kool-Aid, as Sequoia saying in the chat, that this is their rhetoric around it. But what does that mean?
And again, there are layers here. If the people that you know, if those individuals, because there's a dollars to be made, if they're the ones saying stay away from this, why?
No, but if they're saying stay away from this because it's a risk to them, right? It's a risk to the fiduciary. Now, could it be a risk to the people? Absolutely.
100%.
Yeah, absolutely. But it's a higher risk to the fiduciary, because even though they're saying like, oh, well, you can't sue them, we're putting all this protection in place for them so that you can't sue them, it doesn't mean that you can't still pursue a lawsuit.
That's right. See me in court.
Yeah, you can't.
You told me to do this.
Yeah, I mean, maybe a risk is not going to show up and be like, hey, technically, guys, they can do what they want. You told them that they could and that you weren't going to sue because you signed this thing, right? Like your employee handbook paper. That was it. That was what you signed. We made that work in perpetuity. So you can't sue. You've just lost your entire life savings and all of your retirement. And it was at the hands of somebody who had full confidence, right? It was at the hands of somebody who you didn't even know that they were making those decisions. You didn't actually get to make those decisions in those particular investments. That happened to a lot of people in the 2008 crash. They didn't have a choice. And some of them barely recovered before the 2020 hit. So it takes a long time, but this is why we got to pay attention, because even though this could be like hey, pay attention and beware, there's a lot of exciting stuff that comes out of this, because especially for us, this is our world and we are super passionate about alternative investments. This is how we were able to achieve the results that we did. And this is the base of everything that we have taught here. Every single strategy that we have taught here has been around alternative assets. We're thrilled that now, finally, there is some attention given to other options, because we know that you cannot You cannot depend on what hasn't been working for forever and ever and a day. Okay, back to it.
And so when we talk freedom, I want to make sure you and I are on the same page as it relates to freedom. Because, yes, this expands your ability to invest in more. But the piece that's missing here is this simple word, control. Because we live in the space of non-traditional investments. Everything we do is non-traditional. All of the clients I help are focused on taking non-traditional action. The difference between what we do and what's being proposed here is who controls the action. When you have more control over your retirement dollars to invest in to invest in what you want, yes, you are accepting the same risk. But because you have control, you get to you have the ability to now do the due diligence around making sure you're taking an action that is likely to benefit you. Versus, I'm going to give my money to Fidelity, give them all of the ownership with none of the responsibility to expect that they are going to have my best interest at heart.
Well, they
Come
already
on now.
they already have the money though.
That's my point. They already have it, but it's within these guardrails. Now we're talking about loosening or removing the guardrails. That's the problem. It's the lack of control part. Because at the end of here, I will also show you how we can fix it. And I've talked a lot about 401ks. I've talked a lot about, I'll call it defined contribution plans that fit this executive order, because this executive order is related to defined contribution plans. Well, what are they? Well, we're talking 401ks, profit sharing plans, ESOPs, cash balance plans, 403bs. So for my teachers out there, 403bs, simplified employee pension plans, SEP plans, simple plans. So there's a full list of what this falls under, but for the most part, we're talking about employer retirement plans. If you are some type of W-2 employee and you have a retirement account with your employer, 9 times out of 10, it fits in this bucket, 9 times out of 10. There's a few of us that it may not, but for the most part, we're talking 401k-like products. Notice what I'm not talking about an individual retirement account, IRA. As I mentioned before, IRAs are qualified plans, but IRAs are simply, I'll call it glorified savings accounts. They are not that special. So what we're specifically talking about here are defined contribution plans like 401ks. And speaking of 401ks, it kind of brings us to making sure we remember how this all came about. So it's a little history lesson around how retirement accounts came about. And I want to first highlight this. If you notice, from 74 to about 81, there's about a 10-year span of when actions were taken as it relates to retirement account. And then from 80 to 90 or mid 90s, there's another 10-year span there where actions were taken. And then it was from 90 to 2000s. Yeah, it's about another 10-year span there where specific actions were required. And we'll get into why those actions were required. I just want to highlight it's been about a 10-year, I'll call it guise of where actions were taken until you hit 2010. From 2010 to now, there has been a lot of uproar, a lot of actions taken within retirement accounts. Why? Before, it was every 10 years we do something different. Every 10 years, okay, we'll do something different. But for the last 15 years, it seems like every year we're talking about, since COVID, there's been a lot of, I'll call it change and uproar within retirement accounts. Why? Who benefits? What is this about?
Well, I will say that in 1994, so we have before most of these changes, okay, before most of this stuff was, but newer stuff was implemented, including Roth conditions, right? Was a Trinity study, and everyone just ignored it. They went, oh yeah, $1 million. Tell me who in the 80s was getting $1 million, hitting $1 million in their retirement account. Everyone just said, oh yeah, that's the goal. And it sounded like a pipe dream. It sounded like big vision. Right. You know what I mean? It sounded like put it on your vision board and, head to a conference and like, crush it, put the music on in the ice cold room and then make big goals, like make big statements and then say $1 million in my retirement account. And then literally nobody has that. When I say nobody, I just mean the general.
The average saver.
Yeah. The people who need to have it in there so that they have options and healthcare and are taken care of, right? The point here though is that before that, all of that was considered, right? People first, they were considered. This was the pension era.
Right.
Not just the worker, but also their family.
That's right, 100%. And so that kind of forces us, or what we want to do is kind of deep dive that a little bit further, because you're right. Things started with the pension era. And during the pension era, the idea was this: as we approached the 70s, people started living longer. And because people started living longer, the government identified areas of opportunity where maybe the American needs a little bit more assistance to go along with what they've been promised. So this time frame started with assets, additional assets that can be added to what's currently happening along with your pension. So IRA came about in 1974. The idea behind the IRA is simply this: here's an opportunity for you to have something in addition to your pension to help drive you through to retirement so that you can achieve that $1 million nest egg that we all kind of shoot for. And then from there in 1978 came the SEP IRA. Again, these were assets to go along with your pension. But here's the problem. As the workforce began to get older, the workforce began to work longer. What that also meant was retirees were living longer. So it forced corporations to have to pay out pensions for a longer period of time than anticipated. So the corporations needed assistance. Well, where did that assistance come from? It came from additional assets like what happened with the 401 code. Within the 401 code within the section 401 code came the 401k, which was meant to be an asset to assist with the fact that companies were struggling to be able to maintain their pensions long term. So you marry the IRA with the 401k along with a pension, that's a pretty good recipe for an individual to be able to retire. But what ended up happening is that asset became the only asset. Meaning during this period, this period here, pensions went away and companies began, I'll call it, depending solely on the 401k. So what was supposed to be an asset ended up becoming the only asset available to you to allow you to get through retirement. And so the reason I asked that question around, if you look at this 10-year span, again, 10 years, 1 or 2 actions happening. 10 years, 1 or 2 actions happening. 10 years, 1 or 2 actions happening. Last 15 years, there's been about 8 different actions, significant actions associated with retirement accounts. Why? It's because what we've now identified is it's not enough. Your current company's retirement account, your current 401k, 403b, TSP, government 457 plan is not enough. And what the government is trying to guard against is mutiny. What the government is trying to guard against is a January 6th type event focused on why is it I'm working so hard for this, I'm doing my job, but this company can't take care of me the way I was promised. So all of these actions are to guard against the fact your company's retirement account was never designed to allow you to be able to survive retirement. So that is why these actions are here.
And don't forget Social Security. We've paid into Social Security that has been to the benefit of an entirely different generation. And so the whole promise is we're paying in and it's going to be our turn one day. But what they already see is that it's never going to be our turn. It's going to run out. There is not enough money to support everyone the way that they say that it is. So they keep rebranding all of this to say, look at you have more options. Look, we're making this better. But the truth is, when you peel back the layers and you start looking at the amount of fees and other industries that were born out of this and who is actually benefiting the most from this, who's benefiting the most? It's not the average American. It was never the average American.
It was never meant to be the average American.
Right. But the marketing behind
Right.
these.
How it's presented.
Yeah.
Again, there's a lot of excitement about, look at what I'm doing for you.
Yeah, even the IRA, right? It was like, look at you, DIY retirement. Look, you can have your own now. You don't need their pensions. You don't have to be handcuffed to this company anymore.
Right.
You can go out and you can put into this account and you're going to be able to retire comfortably. Wouldn't you want that? And they were like,
of course.
Yeah, no, I would. I hate this job. I would absolutely love to go do something else and know that I can still keep, contributing to my future. And then they said, well, okay, you know what we're going to do? We're going to make a 401k because we can't now change the rules that we made for these IRAs, right?
And
we're going to
again,
make this
401k will go along with everything else.
Sure. But we're going to do this 401k. And because these companies are like, hey, listen, they're not loyal. Okay. We need a little something here. We need a retention tool because these people can just like kick rocks whenever they want to and tell us to. And we don't like that. So now we're going to have this 401k, and the 401k is another almost like a DIY, right? But the company, they get a benefit too. No, they don't talk about that. That's not in the handbook, right? That's not in the orientation meeting. But now they say, hey, you could contribute into this 401k. We've learned a lot about 401ks, and we've learned a lot about what goes on behind the scenes, especially in these brokerage firms and whatnot. And if you haven't watched The Retirement Gamble, we say it all the time. This will be like the 50,000th time we've mentioned it on this channel.
Well, you love giving away slides before they come.
No, but we're going to mention it every 30 seconds like it's a special announcement. Please go watch it. The point is, when you see what happens behind these layers, and how are we not to believe that this was true, what was promised in the front, right? How it was packaged. That's not our fault for believing that and wanting that. Right. The problem, though, is that then they said, this isn't going to work either. Okay, we have to come up with something else. Are people actually going, okay, wait, hold on. It's been 20 years since we started making these promises. Again, more promises, right? Because we'd already started doing that with Social Security. First, we did it with pensions. Okay, if now we're making promises that we're going to do it better. We've done it better. But 20 years later is when they finally started doing studies on it. 20 years later, finally doing studies on it. And that's when they learned
it's not enough.
It's not enough. And so they went, okay, you know what we can do? Okay, all right, here's what we're going to do. We're going to allow them to pay taxes ahead of time. That'll get more people paying taxes, so we're not deferring taxes anymore. It's more taxes up front so that they won't have to pay taxes on the end. And then people who could severely take advantage of this was like, oh yeah, I'm totally into it. Other people were like, what? Why would I want to do that? I can't afford taxes as it is, right? So I need the breaks. A lot of people were not into Roth. A lot of people heavily criticized Roth, just like these alternative investments, right? That are now on coming in hot. They were not receptive to it whatsoever. It took a long time. Matter of fact, it took so long that only after 2020 did Roth start trending. Isn't that weird? Isn't it weird? And it wasn't even Roth as an account type. It was Roth IRA only. Right. People completely oblivious that Roth conditions can live inside of a 401k.
That's right. Little known fact around Roth, and we kind of put it here, it was absolutely labeled as something to help. But here's the truth. It was designed because Congress wanted access to your tax dollars now versus having to wait 30 years. So the idea was if we force them to pay taxes today, we get that influx of cash today, not realizing they made one hell of a mistake because they force you to pay taxes on that dollar today. So if it's $1 and you paid 20%, you gave them their 20 cents, they're happy. But if you turn that dollar into $30 trillion later, you pay zero taxes on that remaining dollar amount. And that was where this is one of of most of the items on this list. This is a huge win for you and I, for us as the average investor, but it was never framed that way. And to your point, that's the reason people ran from it. And it took till 2020 for it actually to start trending. You're absolutely right.
Yeah. Okay. Here you go.
So the truth about 401ks is really it's just a tax advantaged shell. And just to highlight one more item here, the ability to self-direct a retirement account has been going on for well over 20 years. As a matter of fact, the place in the code that says what alternative investments you can invest in has been there since 81. It was just finally glorified and identified and actually put into practice in 2002. And so the truth about your 401k is it is just a shell. It's a shell that allows tax advantage opportunities. Awesome. But there are pieces that you just have to be aware of. One, depending on your age and what that retirement account holds, can have some severe impact on what your time horizon would be as it relates to retirement. So it becomes exponentially more dangerous the more risk you have inside of your retirement account when you're focused on that retirement part, that the moment where you're about to retire. And yes, the current options inside of company retirement accounts are limited. So the fact that this order is designed to open up what that looks like is a positive. But let's be clear, this system was never designed to benefit you. Wasn't. And we talk about this all the time. While this executive action opens a lot of opportunity, let's be clear, your current retirement account is not coming to you for free. And if you were to do the math, that average American saver is spending somewhere around $150,000 in fees over the lifetime of that retirement account. $150,000 in fees.
Or more.
The average saver, if you remember, has between ages 50 and 70 somewhere around 200 or 250,000 to 400,000 in their retirement account. And that average saver is spending somewhere around 155,000 in fees. What could that 70-year-old with only $400,000 in their retirement do with an additional 155,000? And to your point earlier, we'll promote it till the cows come home. I think that's how the saying goes,
Yep,
right?
we're going to say that. We're going with that.
the retirement gamble. And these are not my words. The 401k and IRAs, you put 100% of your money, you take 100% of the risk, and yet, thanks to Wall Street and their fees, you only keep about 30% of your return. You take on all the weight, but only take home about 30% of everything that you've contributed and everything that it has grown to.
Okay, so that's about 19 years. If you were to take that, 2/3 of your retirement account, that is 19 years that is stolen from you. You can go ahead and bring it up if you want. 19 years. Imagine if you would be able to retire earlier. If you're going to be retiring with this much anyway, how long would that last even at age 65 or 70 just based on inflation? No one's doing that math.
Absolutely. And what we talk about on this channel a lot, but what most people don't normally hear is we talk about compounding interest, but compounding interest works the same way as it relates to fees. Meaning, if your investment is 7% for the year and you're paying only a 2% charge on my investments from my from my custodian,
which sounds small.
Again, sounds like I would pay, I mentioned it earlier, I'll pay an additional 2%. But what does that mean? 2% compounding over time, over that 50-year period? If you look at the graph, we're talking about, this is that 2/3 in fee difference. This is what the fee is, and this is what you've accumulated. This is what the fee is, and this is what you've accumulated. You've lost 2/3 of your retirement account just in fees. How much earlier could you have retired if you had that back?
Yeah, you can't really put a price on time. Time that you've lost, time that you've invested into a job or another company, right? And all of it was for the promise of one day being able to feel financially secure and be able to enjoy the rest of your days, however long we have. None of us are promised tomorrow, of course. But if you knew that the difference was, if you knew the difference was 19 years, you could have retired early, just doing the same thing that you're doing now. Why aren't we in an uproar about this? And by the way, this came out in 2013, so this is not new information. This has just gotten worse since then. That's all.
But now apply that to that executive order. That executive order is going to bring what? Higher costs that eat away compounding returns. Meaning, if you're able to buy land, REITs, subject tos, those non-traditional investments, you know you're not going to be able to buy them for free. So if you're already paying a modest 2%, and that 2% compounding eats up 2/3 of your retirement, add another 2 to 4% on top of that.
Well, you got to think though that they have to now bring in other people, more experts, more assessments,
More costs.
Right. There will be more costs, especially on these alternative investments, and there's just more hands in the pot. There's more brokers involved in these deals, and there's less now that we got to have more meetings about the regulation or the trades of these assets, right? So there's just a completely different landscape altogether. But the important part is your time. Because while you're working, this is the part, guys. While you're the one working so that they can have this entire industry. They wouldn't have jobs if it weren't for the working American class funding and feeding them, right? Literally, they wouldn't. This is where in 1981, when 401ks just hit the market, right? That this whole new industry was born. It didn't even exist before. And it just became this whole new thing. Well, we're seeing that with AI now, right? We see it all the time with new changes. And hey, sometimes it's necessary, sometimes it's required. But if you knew that you could stop working 19 years earlier, 19 years is a long time to be working so that somebody else can make probably more than you. And that's the raw truth. All right.
So to your point, again, I love the way you predict slides. To your point, this executive order that opens up this $12 trillion for you to now be able to access alternative investments is not going to come for free. So what we're opening ourselves up to is an opportunity for our retirement accounts to continue to be fed upon by our financial institutions.
Yeah, these fees are so problematic.
Because again, you're not going to be able to take these actions for free.
Here's something interesting. I'm going to add it here as a comment. Sequoia is in the chat. Hey, girl. Great to see you, by the way. She says that's why they are cutting healthcare and other benefits so that the average people die and don't get their money. And that's a hell of an insight, because imagine it's not just the time, right? The years that you could have had back, but it's also the options. When we take away the government assisted and funded programs, and because that's what we were depending on, that's what we were sold on, that we would have that to depend on, and then they can take it away from you. What are you doing today to put yourself in a position so that that cannot happen to you? You're providing your own options. You've become your own bank. There's nobody who can pull the rug out from underneath you and say, oh gosh, sorry that you were depending on this, but now you are out of control. We have complete control, and we get to decide that we're just not going to do it anymore. And why? Is it because any of these people in the decision-making seats are struggling, who understand, who could even relate to the majority of Americans anyway?
Well, I go back to, if you are a hedge fund manager and you had the opportunity to add 12 trillion in assets to your portfolio to be able to invest, like there's nothing but wins available there.
And if you haven't watched our Family Bank series, then you'll know that it not being properly structured and properly prepared, properly protected matters a lot in terms of making sure that your wealth is transferable and it doesn't get caught up in probate and sold off to the highest bidder.
Now, and here's the beauty about all of this. We also are going to identify what you can do about it.
Yeah.
So please what I wanted to make sure we do is set the stage for what this order is saying so that we can help you understand what to look for. Because again, there's going to be a lot of propaganda around why this is something that should be possible. But the key piece here is there are things that you can do about it. None of what we're seeing here is new. And if you didn't know already, you've always had access to these same opportunities. So
yeah, because while this is very, very grim for a lot of people, and they're just like, what in the heck? This makes me angry. I don't like hearing all of this. For other people, they're like, I'm exempt. This can just passes over me. It doesn't even affect me because I have not opted into that type of system. And I am not at all allowing the government to choose and decide my future.
Yep.
And if you've been a subscriber of our channel for any length of time now, then you're probably on that path already or can already make that claim. And I'm excited for you in joining us and being able to do that. If you're not, please subscribe.
Yep.
Do it now.
So what this ultimately means for you, what does this ultimately mean? Well, again, this executive order is building a clear path for those who, I'll call it, manage retirement dollars like 401ks and 403bs. This is a clear path to be able to include alternative investments. Now, will it happen? Won't it? I cannot tell you whether or not this will go through. But what I can tell you is there is a clear path being created. And ultimately, this is opening up $12 trillion in assets for those who before couldn't touch it, couldn't access it. And let's be clear, they are not going to allow access to 12 trillion for free. So be prepared. And then most fiduciaries, though, here's the other part. And again, I've been using Fidelity all day. From this thing from Fidelity's perspective, what does Fidelity do? Fidelity doesn't do real estate. Fidelity doesn't buy land. Now they may do some of their own alternative investing as an entity, but for those who are who have their money with, 9 times out of 10, it's just mutual funds, stocks, and bonds. So most fiduciaries, most financial institutions will put this on a very low list of priorities. Why? Because of the risk. And I'll kind of dig into that a little bit more. But let's be clear, what you're seeing today, what you're hearing today in this executive order is not new. The ability to invest in non-traditional investments has always been there. Your ability to invest qualified dollars, retirement dollars in non-traditional investments has always been there. The question you want answered is why you may not have been able to do so. And that is something we can fix. I guarantee you, I could fix this executive order in one shot, but it would cause some people to have to make concessions. And so my point is you never needed permission. You never needed someone's executive order to identify whether or not you can or cannot invest in non-traditional investments. You never needed it. It was never a requirement of you. So this celebration around this order is really a lackluster event because it's always been there. It's been right there in your face the whole time. And as it relates to financial institutions like Edward Jones or Fidelity picking up these non-traditional investments, let's be specific as to what I'm talking about. What is the likelihood of you being able to buy real estate or a self-storage facility within your retirement account with Fidelity? It's going to be fairly low. So the likelihood of this actually happening, probably not. Raw land, probably not. Foreclosures. You know how hard it is to get people out of a foreclosure property? What is the likelihood of your current fiduciary, your current financial advisor, the financial institution that holds your company's retirement account? What's the likelihood of you being able to buy foreclosures and property? Probably not. Probably not mortgage, maybe mortgage pools. I consider mortgage pools like REITs. It's possible, but 9 times out of 10, probably not. Deeds and notes, again, people, water rights, hard money lending. Can you picture a bank like Fidelity allowing you to be a hard money lender, but a hard money lender where? Who's writing the promissory note? How do we make sure it's secure? How do we put the right guardrails around your retirement account to make sure you're not taken advantage of? Sounds good, but probably not. Tax liens? I don't think so. What is that? Liability, limited liability partnerships, like none of this. Precious metals? Precious metals. Let me go back here. Precious metals. For those of us who cannot buy gold and silver inside of our retirement account, would this be an opportunity? I think precious metals is absolutely a go. The likelihood of us being able to add precious metals as a viable option within your company's retirement account, I think is absolutely a go. Factoring your own receivables, absolutely not. LLCs, absolutely not. Private businesses, again, too complicated, absolutely not. Cryptocurrency. What is the likelihood of this administration, based off what you know today, based off how friendly this administration is in the digital currency space, what is the likelihood of cryptocurrency being offered? So again, of all of the non-traditional investment, and this is a short list, but of the non-traditional investments, what's the likelihood of cryptocurrency being added? Is it possible that this executive order that is not going through Congress, that is being rushed through to identify where the opportunities are inside of your company's retirement account to be able to identify how non-traditional investments can be added, and it be with a fiduciary like a Morgan Stanley, a Fidelity, a Vanguard? What is the likelihood of cryptocurrency being added? What do you think? Oh, and who benefits from cryptocurrency being added into your retirement account? Is there anyone in a position to create an executive order, push it through his administration so that an asset class can be created as an option for your company's retirement account to add it? Is that possible? So I mentioned earlier that there might be a conflict of interest here, because if your retirement account is allowed to add Bitcoin, or if your retirement account is allowed to add digital currency as an asset, would it be easier to build guardrails around a digital currency that is actually coming from our government? If we're talking about safeness, if we're talking about security, is it possible that you could build security around a digital currency that is coming from our government into your company's retirement account? I don't do conspiracies. I just do common sense. But my common sense says if we're talking about non-traditional investments, the likelihood of any of these being added to your retirement account is quite low. Precious metals, absolutely. Why not? Cryptocurrency, mm, I would love feedback. And so what have we learned as it relates to this timeline? We've learned that in the pension era, companies were screaming, I don't have enough to be able to sustain because the workforce is getting older and I'm bleeding. I need help. The Social Security era also said, you know what? I don't know that I'll be able to sustain because the workforce is getting older, and for the government to be able to supplement the pension, I don't know that we'll be here.
And there's more people.
The 401k era came in and said, we'll help. Here's a tool that you can add to this and this that will help. But what did corporate America see when they saw the 401k? Here's an opportunity for me to stop doing a pension. And what are we learning? Why has there been so much movement over the last 15 years inside of retirement accounts? It's because what's not being said out loud is your retirement account is not enough. So how do we get there? What do we have to do? Well, hopefully what you're gathering from this live, hopefully what you gather from this channel is we've had enough. The problem is control. The problem is We haven't had it. What does it look like when we have control? You want to fix this problem? I'll give you the answer to the test. You want to fix this executive order issue. It's not giving Fidelity the opportunity to offer non-traditional investments. It's giving me, the employee, the ability to self-direct a portion of my company's retirement account. You want to fix this problem? Instead of opening up your entire company's portfolio to non-traditional investments, maybe open up 20%. Here's 20% that you can do an in-service transfer and go invest in what you want. Because for those of us who are in this space that understand how this money can be used, this now allows me a tax advantage opportunity to be able to build wealth outside of the market. Like there's an opportunity for that. But if you're going to place that opportunity on a Fidelity, they're going to nickel and dime you to death. If I have the opportunity to do it, I can go get I'll call it a custodian that does not charge fees to be able to take action. So what's missing here is simply control. You want to fix this problem? You need to provide me with more control to be able to access my dollars to invest in what I want. And I get it. If I'm your company's employer, if I'm the employer, I don't want you taking the money that I am matching for you to be able to go do these things. I get it. So don't do 100%. Give me 20. Give me an option to be able to save myself. But this executive order is not putting us in a position to save ourselves. This executive order is saying the government will save us.
Again.
How well has that been happening?
Haven't done it yet.
I'm just saying. So what can you do? What are your options? What's available to you? Well, again, you never had to wait for this executive order for you to have control. A self-directed IRA, a self-directed 401k has been allowing you to invest in non-traditional investments since inception. We own a little company called Self-Directed Retirement Plans. It's only been around 20 plus years. We're on the first page of Google. We're on the first page of Google for a reason. Why? We've been offering this opportunity for you to be able to invest in non-traditional investments when you want to. The goal for you, if there's takeaways here, the takeaway is, I know this is coming down the pipe, but how can I take more control over my future? Why? The people who tend to benefit from this $12.2 trillion being opened up is not going to be me. So how can you put yourself in a position to have more control? And how can we help? As I mentioned, how do we do that? If you simply put self-directed 401k in your favorite search engine, you'll find that we're on the first page of Google and we've been there organically for quite some time. And it's because our objective is to give you control to be able to invest in what you want. I have fiduciary responsibility, which means I can't tell you what to invest in, but what I can do is get you structured properly so that you can invest in what you want. And when I say control, I'm saying your ability to not just invest in mutual funds, stocks, and bonds, but it's everything on that list plus some. There are things that we haven't even contemplated. There are some things happening in AI that your 401k can be directly involved in. Off the grid, off the market, growing tax-free or tax-deferred growth, or tax-free or tax-deferred income. It's pretty powerful. And ultimately, we're talking about one of the 5 things that we focus on this channel. We're talking about you being able to access your qualified retirement dollars in the form of a self-directed retirement plan to invest in what you want. But what else is there? What else do we offer? Well, how about in addition to self-directed retirement plans, as in qualified retirement accounts like IRAs and 401ks, if you were to structure life insurance correctly, you have the ability to generate tax-free retirement income using properly designed cash value life insurance policies. There's infinite banking, there's velocity banking, there's annuities. What if, again, that 20% that I was referencing, how we fix this problem, instead of opening up your retirement for alternative investments, maybe they offer 20% as, again, an in-service transfer for you to be able to invest in what you want. And what if you took that 20% and dumped it into an annuity? Got it out of the market totally and focused on pure growth. My point is there are so many opportunities here. And as it relates to what you can invest in, again, that's all of it. That's any, I'll call it, non-prohibited transaction is accessible for you to be able to invest your qualified dollars. And that's whether we're talking about an IRA or 401k. There is no restriction, and that includes traditional accounts like mutual funds, stocks, and bonds. So it's everything. This has existed for over 20 years already. Why didn't you know about it? And what actions are required for your employer to even offer it? I've worked over these last 3 weeks, I've worked with three different employers who have full-time employees who started their own 401k, meaning the 401k that they have with the company that they own was 401ks that they initiated. And they wanted to understand how they can invest in non-traditional investments using the retirement account they created. All that's missing is the plan documents need to be updated so that those things are offered. I've talked with 3 different companies this week to help them restructure their current retirement portfolio so that they can offer non-traditional investments to their employees. My point is, an executive order was never required. This has always been accessible. The key is you just need to know who to talk to. And what's so great about a self-directed retirement account? I think if you were to go through this list, what makes it great is control. What makes it great is your ability to invest in what you want when you want. It's that freedom piece. And when I say freedom, it's not I have to ask permission to be able to take action. There's a lot of commercials from the equity trusts and the IRA services that talk about these same opportunities. But all of them are what's called active custodians, and you have to gain their permission in order to take action. When I say self-directed, I'm talking your ability to be able to take action without anyone looking over your shoulder or needing to ask permission. So that means less paperwork, freedom to invest, no commission, no fees, meaning because these are self-directed retirement accounts, there are 0 custodial fees associated. So that 2/3 problem that you have with your current retirement account is eliminated because we're using custodians that charge 0 fees. So there's 0 commissions being nickel and dime from your retirement account.
I got to step in here because not all facilitators or third-party administrators are the
Function the
same.
same. Amen.
This is what you should expect. This is for people who actually use these accounts, people who understand the freedom, love the freedom, want to honor the fact that we have access to stuff like this, would continue to extend that out to their clients as well. Not all companies are the same. We learned that when we first got our first self-directed account. And it really wasn't, it really was not a self-directed account. There was a lot of red tape and a lot of permission that we still had to get from this company that said that we had all this freedom. And this is different. We're different. We got to be the change that we wish to see. And we partnered up. We partnered up with self-directed retirement plans, and then now we own self-directed retirement plans. And that's how it goes. If you wish to have complete freedom and complete control, you got to ask some questions. Because if you don't know what you don't know, then you find yourself wanting to invest in, move forward with an investment opportunity only to learn that you cannot. And you've lost the deal now because of all of the red tape, and their urgency is not your emergency is not their urgency, and they're not going to push things through. And if they did have an option to push things through at a more rapid pace, it's probably an extra fee.
Very much so. Very much so. You're not getting anything for free.
Right.
And so when I talk about being properly structured, or when I talk about having a self-directed retirement account, what do I mean? I mean literal access to your retirement dollars to invest in what you want via checkbook or transfer. Meaning you get to invest in what you want when you want, and there are no restrictions as to what that looks like. And that can be a little bit frightening as well, because if you do the math on what I'm saying is, where are the guardrails? Well, you are the guardrail. With a self-directed 401k, you are what's called the trustee. With a self-directed 401k, you are the sole decision maker of this process. And as the sole decision maker, you are responsible for making sure the actions that you take are the right actions. And I go back to this executive order around opening up your retirement account to be able to invest in non-traditional, providing you some type of self-directed opportunity. Well, if it's going to be truly self-directed, you should at least be in control of your destiny. But what they're saying is you can have a self-directed opportunity. You just have to do it through this broker dealer. And remember, that broker dealer is going to take an additional 2 to 4%. And what does 2 to 4% compounded over time look like?
19 years. It can look like 19 years. And if you just tuned in, scrub back and rewatch that part.
And so just because it's a qualified account doesn't necessarily make it secure. So the idea is putting yourself in a position to where you have more control over what that security looks like. Meaning, if I'm going to become a hard money lender inside of my retirement account, me lending to people that I know, businesses or asset classes that I am knowledgeable of, the likelihood of me being able to grow my money in a more secure fashion is much more likely versus me taking my qualified dollars, giving it to Fidelity for them to be able to invest in non-traditional investments like land, REITs, and subject twos. Less likely. And how about this? As we mentioned, these fiduciaries, 9 times out of 10, will not want to participate. So how is this possible? Meaning, what are the actions required for this to make sense? Oh, let me do that. What are the actions required for this to make sense? Well, I wanted to give you an example of a gentleman by the name of Adam. And we worked pretty closely with Adam. Adam came to me wanting access to his retirement dollars. He wanted the ability to be able to invest on his own in non-traditional investments. And he had a previous employer plan that allowed him access to be able to do so. So what I created for him was a self-directed 401k. And Adam was able to take that self-directed 401k and invest in non-traditional investments, put himself in a position to where he was actually able to build assets outside of the traditional market. So we're talking, what was he invested in?
Multifamily,
homes,
single family,
multifamilies.
fix and flips.
Absolutely. A lot of opportunity that allowed him to grow his retirement to the point where it put him in a position to where he and his partner created their own firm, which put him in a position to quit his job, eliminate the ability for someone to have more control over his future, and put himself in a position to where now what is he investing in, sweetheart? He's investing in RV parks, multifamilies. He went from 100+ doors to now he's investing in more RV parks. The bottom line is there's opportunity for him to be able to generate more retirement income over time by putting his money in a position where he had more control. You have the same opportunity. You have the same ability to be able to take control over your retirement dollars to be able to take action just as well.
What I love about Adam's story is he really didn't know anything about any of these industries when he first got started. And he was just like, I don't know. I mean, I'm not saying that it's going to be easy, but I'm going to say if I don't try to learn, then I will never know.
Right. I just want control.
And that was his total attitude towards it. He was just like, I know that I don't want to be sitting here. And he had a big why he didn't want to waste his time and his future sitting behind a desk, working for a company, helping them build. And
you go calling out slides again.
Well, it's my favorite part of Adam's story.
Exactly. Well, let's jump to it though. What is the why?
Well, hold on. Well, no, go back.
Okay.
We can get there.
Okay.
Adam and his partner, they had battled with how do we systemize this? How do we figure this out, right? Everything is figure outable. We just got to figure it out.
Absolutely.
And they have a podcast and they were talking about some of the struggle along their journey and figuring out like their first door to their first 100 doors, right? And we have watched him scale exponentially in a very short period of time because he understood one thing: where his leverage is.
Right. And how to control it. Because again, once you have control, these doors open up and availability opens up to you to be able to take action where otherwise maybe you don't have the capital today to be able to take that action. But when you have control over your qualified dollars to be able to invest in what you want, these other opportunities present themselves.
And have you ever watched somebody around you who has been uber successful, and you're looking at them and you're just like, wow, I wish I could learn to do whatever it is that they do, but I'm like stuck in this industry with this job, and there's like an income cap on
Right.
what it is that I'm doing.
Right.
So I wish that I could like be involved somehow, but I don't even know how to talk to them about it. Like, I don't know if they would even be interested in teaching me. I don't know if I could get involved in some way. And a lot of times people assume that somebody who's especially a real estate investor, that you would have to know how to invest in real estate, be having conversations with them about the deal and whatnot.
Right.
We invest in a lot of real estate, and I'm going to tell you right now, I've had one conversation about a deal.
I haven't walked a property in probably 15 years.
We have a self-storage facility we've never even been to. And we'll keep it that way, because that's not the point. We are not investing in a community. We weren't investing in a facility. We weren't investing in a business type. We were investing in a asset class, right?
That asset class is focused on what?
Mailbox money. And that's
Generating and creating mailbox.
But that's the point, though, is that what I was trying to say is that Adam then got to ask other people, who else wants to make mailbox money? Who else is into this? Because I would rather do the deal. I would rather be here using my experience. And he's not the only person. We're just using him as an example, because we work with a lot of different people like this. And we've invested with a lot of different people like Adam. The point is that the mailbox money piece, this is the part. This is essentially what the 401k was supposed to be, right? This is what the Social Security was supposed to be. This is what pensions were supposed to be. It was supposed to be mailbox money. You just keep pumping in, you just keep working, and you just keep investing your time in, and then you're going to start getting mailbox money. That's essentially what the promise was. But there's a whole crew of people. There is a swarm of people who are actually achieving this on a very a highly successful level. And I'm grateful. Your network is your net worth. And I'm grateful that we have networked our way into some communities where we have seen those types of returns. And we understand that it's not the who you know, what you know. It's different. I think the understanding your leverage, understanding what your opportunities are, and knowing that sometimes it's just your leverage is your part. This is your piece of their puzzle, and you have an important piece. And as long as you play your part, this is just your piece, that you do have some protections involved. I don't know what else to say about it other than the fact that I wish more people understood it, but it's kind of wild to me to think that we're here in 2025 and this has existed for well over 20 years, this opportunity, and that instead of just saying there's something that already exists that is underutilized, we're going to try to somehow force with new restrictions, and it's not going to be the same. It's not that your 401k now gets to invest in alternative investments, because the same rules don't apply. Right. And that's what makes this so sad, is that what we're looking at are people who have achieved true freedom. We've achieved true freedom. And what we're looking at is a bunch of people who are going, maybe I could invest in alternative investments now because I have all this money that's over here, and what it is invested in is not giving me the returns that are going to give me that freedom, right?
And so an objective next week is to kind of break down the structure as to how to get there, because this is about understanding where your leverage is located is key, but it's also how that leverage is structured for you to be able to take action. Because whether we're talking about qualified retirement accounts, life insurance policies, or just debt in general, how it's structured, how and how it's available to you is key for you to be able to take the opportunity of being able to generate and create mailbox money. So that's what we'll focus on next week as well.
Yep, that's right. So tune in then.
So to your point, Adam, what did he want? Well, like most of us, his main objective was to put himself in a position to where he could retire on his terms. Hard stop. The objective was to be able to have more access to his qualified dollars, to be able to invest in what he wants so that he could have more control. And he was able to do that. But his why is pretty in depth. And I think to your point, sweetheart, he was talking about how and I think a lot of us fit in this category where our objective is to be better than the legacy that was left before us, right? And he watched his father work himself to death. He watched his father not have an opportunity to truly enjoy what retirement looks like. So his objective was, I want to put myself in a position where I control that time frame. I control that time horizon as to when I decide when I'm going to retire. Why? I want to make sure I'm able to enjoy it. And I want to make sure that 2/3 of my time is available for me to be able to use, and not 2/3 of my money is going toward to fees that someone doesn't have any concern as to what my outcome looks like. And his other objective is to put himself in a position where he could also assist others with being able to do the same. And that's the beauty of the Cherry Pick Capital group that he's created. Is it is an opportunity for you too to become I'll call it a passive investor in some of these opportunities to be able to generate and build wealth. So we'll kind of break down next week again what that structure looks like for you to be able to take advantage of that. So if you're wondering, how do you begin? Where do you start? Like how do you take action? Well, it starts with the tools that we offer. Go to selfdirected.info/live. Go to selfdirected.info/live, or you can also go to our self-directed retirement account site, which is sdretirementplans.com, to understand how you can create your own self-directed 401k or self-directed IRA, what each means, what are the differences between the two. There's a lot of, I'll call it content and available resources on the site to be able to educate as well. We're talking definitions of what is an IRA all the way down to what can I invest in? What are those non-traditional investments? So again, go to sdretirementplans.com, sdretirementplans.com to be able to access. And when you're ready, if you have a previous employer plan, and again, whether it's an IRA or some old retirement account sitting somewhere and you want to have access to it to be able to invest in non-traditional investments, you do not have to wait on some executive order to give you or provide you with permission. You have the ability to create your own self-directed retirement account. And you can download that application to be able to and it's a fairly simple application as well to break down what those steps are. You're just looking for your personal information, the adopting employer. If you're wanting a 401k, you do need a business, any LLC, any S Corp, any C Corp, any self-employment income. So you do need a business to have a self-directed 401k.
Uber.
But a self-directed IRA, you just need any earned income. Everyone can have a self-directed IRA. Both of those will allow you to transfer penalty-free, tax-free, any previous employer dollars that you have to give you the autonomy to be able to invest in what you want.
Hold on. Some people get this misconstrued because when you say self-employed income, they think that they have to now own a business. And how are they going to do that? What are they going to be making soaps and lotions or whatever? You know, they got to have a full-fledged business. You don't. You have to have self-employed income. And so for a lot of people, that's DoorDash, that's Uber, that's Lyft. That can be a lot of those side hustles.
Be any MLM.
Right. Okay.
It works.
It's true, but it's self-employed income. That's what it's qualified and classified as, especially if you're a business owner. You cannot have full-time employees. And that's the other thing, is that if you don't know this going in and you think to yourself, well, I've got a business now, so now I have an employee, because you're looking at this thinking that you would get some sort of tax break.
Right.
You're thinking that you'd be structuring yourself in a way that you get some other type of benefit, not realizing that your biggest benefit is to first be educated, then get self-directed. And this is where you take control. You're no longer just following blindly what you think is the next shiny benefit or object, but you have a strategy. You understand what it is you're doing, why you're doing it, for how long you're doing it, and you know what direction you're going. It's most important. So it's self-employed income. It's not necessarily owning a business.
And notice, it's self-employed income. Nowhere does it state how much.
Right. Do you sell things on Facebook Marketplace? Do you sell things on eBay or OfferUp? Do you
I have a client who
do you
coach kids on the weekends, teach them how to box.
Yeah. Do you police comments on Facebook and get paid for that or whatever? Are you an influencer? Are you an influencer and you get paid for your content that you put on social media?
That is true.
I mean, think of all the ways that people are making self-employed income now that all qualify. And again, to your point, it doesn't matter how much to be able to qualify.
That's it.
Yep, that's it. And then of course you gotta fund it. So understanding that too, but that's what we're here for.
That's right. And so, what is that process for creating a self-directed 401k? Well, it starts with where your money is currently located, whatever that current custodian might be. And it does not matter because a qualified to qualified move is a penalty-free, tax-free transfer or rollover. And so, it doesn't matter the custodian, whether it's a mom and pop, whether it's Empower, Fidelity, Morgan Stanley, none of that matters. Once I create an empty checkbook controlled 401k for you, that 401k has its own EIN number, which allows it to have its own checking account. Once I create that for you, then it's just a matter of transferring funds from that previous employer plan into your new self-directed 401k checking account. And once that's done, you now have full access to be able to invest in what you want. And again, we assist a myriad of individuals. Who does this consist of? In order to have a 401k, you do need a business. That business can be any self-employment income, any LLC, any S Corp, any C Corp. You get paid 1099, that is absolutely enough for you to have your own retirement account as long as you don't have any full-time employees. And notice I said full-time employees. Part-time employees, not a problem. Contractors, you can hire 1099 contractors all day long within your business. And as I mentioned, over these last few weeks, I've met with a few different business owners who have full-time employees and wanted to be able to take action like this. So what I was able to do is create a self-directed IRA for them and help their current custodian that holds their current 401k identify in their plan documents how to create in-service transfers for him and his employees. So just because you may be dealing with an employer that doesn't offer it today doesn't mean it's not possible. Sometimes it's just a matter of updating the plan documents to be able to do so. And I think that's it, sweetheart. So any questions from there? So again, if you need anything, go to sdretirementplans.com. There's a lot of resources there to be able to help you understand how to attain a self-directed IRA or self-directed 401k. And you can also go to selfdirected.info/calendar and jump on my calendar.
Yep, that's it. Okay, I haven't seen any questions come in, but we have a lot of comments that have come in just in terms of what they think this means, and of course, a lot of people understood the assignment in regards to the conflict of interest. So, what I'm curious about is if we could just in the comments after we're done going live, what questions do you have about a self-directed for? Did you know that one existed? Is this channel the first time that you're learning about them? Because it's not the first time we talked about them, obviously. If you found us through a Google search and you found your way through our main website, the sdretirementplans.com, and then you landed on the channel and you've learned there's 20 years of blog and article material, tons of resources that really break down all of the innards of self-directed retirement plans and how they work, what not to do, what to do. And then of course, then we're also here to help. So if you have any questions, please put them in the chat. Next week, we are going to talk about how are people using these? What are the most common use cases for these types of accounts, and how are people winning big with them? That's really the only thing to talk about. The only thing to focus on is how are people winning big with self-directed accounts and how they've been doing this for a very, very long time.
Right. This is not new. This executive order there's a lot of fanfare around it, but I'm sorry, this has been around since 81. You've been able to actively do this since 2002. So this is not new. The question you ask is, who benefits from this truly happening today?
Yeah.
And why can't it be you?
What's interesting is we were talking about the history of retirement plans and like what that timeline looked like. And at what point Roth came into the picture in 1997. And it wasn't until like 2020s, right, that we started to see Roth started trending like it was this new thing or something like, oh, you don't have a Roth IRA? Like you need a Roth IRA. And I'm thinking to myself, like, do you mean a Roth 401k? Because if you don't understand the limitations and all of the penalties associated with an IRA, by the time you learn that, you wouldn't even want to mention any or suggest or encourage anyone to get an IRA. It wouldn't even be a thing. At this point, they just should not be things anymore. There's nobody who truly benefits from having them unless it's an asset. But to promote it heavily, like it's the biggest thing, it's like a 10x difference of the max amount that you can put in your IRA to what you can put in your 401k.
There's so many pieces.
There's a lot of differences.
What
Yeah.
contribute the fact that if you and your spouse have your own retirement accounts, your spouse can have an IRA, you can have an IRA. Guess what that means? That means double the amount of fees associated with retirement accounts. But with the 401k, you and your spouse can commingle funds in one account. You just eliminated custodial fees times two, meaning that's not 2/3 more money back into your pocket, right? It's even more than that. So there's so many pieces here, and we kind of dig into some of those things next week.
Gabo has a question. Can you do a mega Roth backdoor on a self-directed 401k?
Absolutely. Mega, again, these are just marketing terms. Mega backdoor Roth. It's really just taking advantage of all of the opportunities. So I break down mega backdoor Roth. That's saying I have an IRA and I have a 401k. That IRA, I can put $7,000 to $8,000 in it. It can be a Roth IRA. Okay, so now I put $7,000 to $8,000 into a Roth IRA that gives me tax-free growth. Cool. In addition, I can have a Roth 401k, which will allow me to do what? Put away, depending on your age, 23,500 if you're under the age of 50, 31,000 if you're over the age of 50. Plus, you can put in an additional 20 to 25% of your income up to 46.5. Hey, Gabo, and if you're, age 60 to 63, you can add an additional 11,250, I believe, on top of that. So Mega is saying you add all of those numbers together, you absolutely can have all of that. I want to say it's somewhere around 86 grand you're able to put into a retirement vehicle. Now, there are some requirements for you to be able to do so, but your question is, can you? Absolutely, you can. Great question.
Yeah, great question. We also have not really a question, but Kimmy's in the chat and she's saying, I get confused about the IRA Roth and 401k Roth.
People do, man. So IRA, individual retirement account, IRA. It's just a glorified savings account. It's a savings account that's been put in a position to where you can build and generate qualified growth in it. Awesome. 401k, 403b, TSP, government 457 plan, SEP IRA. All of these are just qualified retirement accounts. That's it. Roth really does confuse people. Here's the easiest way to remember it. All retirement accounts start out as a pre-tax option, meaning the money you put into all of these vehicles, IRAs, 401ks, all of them, you're putting in dollars that have not been taxed. All of them. Well, majority of them have a Roth option. Roth option is just saying, my dollar, I'm going to pay tax on this dollar now instead of waiting for the future. So pre-tax is saying, again, all qualified accounts start out as pre-tax. Pre-tax is saying, hey, when I put this dollar into my retirement account, I'm not going to pay taxes on it. I'm going to wait till I hit retirement age, which could be 30, 50 years from now. When I hit retirement age, I'm then going to pay taxes on that dollar, and I'm going to pay whatever the tax rate is in the future. Okay. Roth is saying, nah, I am not going to give the government an open checkbook to charge me whatever the tax rate is 50 years from now. I'm not going to do it. Because logically, we know taxes are not getting lower. Taxes are only going up, which means whatever the tax rate is in the future is going to be higher than it is today. So instead, I am going to convert this qualified dollar to Roth. All that means is this dollar that I'm putting in this retirement account, at the end of the year, when I file my taxes, I'm going to pay taxes on this dollar that I put into my retirement account. So Roth is just a condition. Roth is a condition of a dollar. And Roth can be in an IRA. Roth can have that same condition in a 401k. So you have to separate Roth. Roth is just a condition of a dollar. The IRA and the 401k, those are two different types of retirement accounts. So whether you're talking about an IRA, it's a glorified savings account. Talking about a 401k is a pension plan. A 401k is a trust. Two separate types of retirement accounts, but they're both just retirement accounts. And then Roth is a condition of either one of those accounts. You can have a Roth IRA, you can have a Roth 401k, but it is just a condition of the dollars in it. And that condition means I've already paid taxes on the money I've contributed, so any growth is growing tax-free.
And there it is. I wonder, it makes me wonder, because it didn't come out till 1997.
Mhm.
All the years we paid for long distance calling, prepaid cards, right?
Okay,
We
listening.
we've been doing the prepaid for a long time, and the government was like, you know, what would be cool if you prepay taxes. That would be cool if we can prepay long distance calling. Do you guys remember this? Like 10 cents a minute. Could you imagine? Then you can prepay your taxes. So that's my version.
If you made me think of something. That's kind of how stamps work,
Yeah, right.
right?
Yeah, right. Yeah,
If you paid 25 cents 10 years ago for a stamp, that same stamp is not worth $1.49 or whatever stamps are today. You can still, you still have the value of that stamp is the same.
the forever stamp.
The forever stamp. The value of the forever stamp is the same regardless of when you bought it because it held its value. And that's what Roth is. Roth is saying, I'm going to pay the tax on this dollar today, but as it grows, I don't have to worry about whatever the tax rate is because I will never be impacted by it. I will be able to use this dollar however I would like in the future and not be impacted by anybody's tax.
Yeah, except for you can be impacted by it because your entire account can be considered voided if you don't pay attention to the rules.
There are rules.
Yes.
And,
Yes.
and I think this executive order is what the Department of Labor is doing is they are assessing the rules inside of qualified accounts to understand if we can involve these non-traditional investments. That means that there are rules associated with your retirement account that you have to follow. And if you don't follow those rules, it could cause your entire retirement account to be voided. But there's ways around those as well.
Yeah. Stay tuned in and subscribe if you haven't already, and share this out with somebody so that they can get educated and that they can start to feel, you know what, I can do this. I don't have to depend on these other people to make these decisions for me. I can get self-directed. I can get educated. I feel empowered. I can do this. And again, we go farther and faster when we go and we grow together. We truly believe that. And we've seen it right here inside of our community. We've seen it in other communities that other people have built, and they have brought them or us inside of their communities to help educate them on how to become self-directed and all that is entailed. So, okay, I think we are good on questions.
Perfect.
You have anything else you want to add?
No, I think we covered it. Tune in next week as we break down the how. What is it you can do? What are the actions you can take? How do you become properly structured to be able to invest in what you want? And we'll kind of dig into that. I know there's about 90 days left on this executive order before the results come about. And I know there's going to be a lot more fanfare around this. My only ask of the audience, especially those of you watching this on replay as well, pay close attention to what's not being said. And remember to ask the question, who benefits?
But also remember that you've never had to have an executive order to be able to do this. And so while other people are saying, put your blinders on, don't pay any attention, there's too much risk, it doesn't matter, know that they're doing it for a reason, and it does matter. They would not be doing this if it didn't matter to somebody. What side do you want to be on? The side that is going to benefit and be feeding their families, or do you want to be on the side that is doing the feeding, right? Like that is being fed off of, literally with fees.
That's it.
You can be in control and take advantage of these opportunities and these asset classes, and you don't have to go through your employer to do it. Matter of fact, a lot of people have been feeling very chained to their employer because of whatever benefit that their employer was providing them before. And this may be part of that opportunity to jump, to take the leap, to move into a different industry. Once you have a previous employer plan, now you can roll that over into a self-directed retirement account. And so you have more control over it then. So the silver linings, folks, stay tuned in. We're going to go over next week is the mailbox money. We're going to talk more about that and just what are some examples of mailbox money. We've done this before. We're going to do it again. We're going to give even more examples. If you guys can do us a favor, though, if there are particular examples that you would like to see broken down, help us out by help us to help you. If there's something in particular that you would like to know more about in terms of something that you've heard, drop it right here in the comments, and then we'll make sure to add it in next week's live stream as well.
Absolutely.
Got it? Okay, well, we like to end with, and thank you guys so much for tuning in. Time is our most valuable asset, and we're so grateful that you're spending your time here with us. We like to end with, if you didn't come from a wealthy family,
You can make sure a wealthy family comes from you.
so stay tuned,
Stay protected,
stay focused.
stay connected.
I'm Angelique,
And I'm Donnell.
and our goal is to help you.
As always, get self-directed.
And to do that, we have a ton of free resources, as we've shared already here. We've got even more in the interwebs, in the web pages. So get in there and go take advantage of those. And we will see you right here next week, Tuesday, 5:30 Pacific Standard Time. Thanks for tuning in, everyone.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you
Get self-directed.